Why capital concentration is becoming a structural market risk. Capital does not spread evenly. It clusters around assets with deeper liquidity, platforms with reliable execution, and systems perceived as operationally stable. In digital markets, that clustering happens quickly and at scale. What begins as efficiency can evolve into structural concentration risk. How concentration forms. Capital concentration follows incentives. Liquidity attracts liquidity. Reliable platforms attract more flow. Widely accepted collateral gains broader use. Over time, a feedback loop emerges. More capital leads to better liquidity, leads to stronger perception of safety, leads to even more capital. In stable conditions, this can improve efficiency. Under stress, it creates dependency. Concentration changes liquidity behavior. Liquidity is often treated as protection against volatility, but concentrated liquidity behaves differently. When depth depends on a narrow set of providers or venues, execution quality can deteriorate quickly. Spread stability becomes conditional. Market resilience weakens simultaneously across systems. The market may appear deep, but that depth is less diversified than it looks. Platform-level concentration. Digital markets rely heavily on a small number of venues. This creates structural dependencies across execution systems, custody infrastructure, settlement processes. If one platform experiences disruption, multiple market functions can be affected at once. Alternatives may exist, but shifting capital during stress is rarely frictionless. Asset-level concentration. Certain digital assets become central to the ecosystem. They function as trading pairs, collateral bases, liquidity anchors, settlement instruments. As dependence on these assets grows, correlation across markets increases, diversification becomes less effective, system-wide sensitivity intensifies. Positions may appear diversified while still relying on the same underlying exposure base. Behavioral effects of concentration. Concentrated systems influence participant behavior. When exposure structures are similar, liquidity providers react to the same signals. Large participants rebalance simultaneously. Collateral-driven adjustments occur together. This synchronization accelerates market movement. Behavior becomes structurally aligned, even without coordination. How institutions monitor concentration risk. Institutions do not attempt to eliminate concentration entirely. Instead, they measure thresholds and dependencies. Key monitoring areas include exposure distribution, collateral overlap, liquidity source diversity, platform dependency, correlation during stress conditions. The focus is not just where capital exists, it is how interconnected that capital becomes. Concentration as a market signal. Concentration reflects both strength and vulnerability. It may signal institutional participation, strong liquidity conditions, infrastructure preference, but it can also indicate systemic dependency, reduced resilience, higher sensitivity to disruption. Institutional market structure analysis treats concentration as both an efficiency signal and a structural risk indicator. Kenson Investments helps institutional participants evaluate concentration thresholds, collateral overlap, and liquidity dependencies through disciplined market structure analysis. If your exposure relies on a narrow set of assets, venues, or liquidity sources, concentration risk may already be embedded in your portfolio. Visit KensonInvestments.com and assess concentration through a structural lens.